Hey all, welcome to ShareTrack. This is Raj here. Today is a continuation of my video from yesterday. I have a few more data points to discuss. To summarize, my conclusions yesterday were that the market will move in a range-bound manner until the debt ceiling issue is resolved. It may seem like the markets are back into a bullish phase, but it will be within the context of the range. Keep this in mind as I discuss the new information I have. So let's get started. Welcome back, friends. I had identified the range of around 297.86 as the top level and 259.56 at the bottom level for QQQ. The thinking was that the debt ceiling issue will have to be resolved before any possibility to break out of this range. We have been in this particular range of 259.56 at the bottom and 297.86 at the top, all the way from around, 14th of September to 2022. So it's been a while and we have not been able to break out of it. So it's a very wide range. So it may seem like when we are going up continuously, it may feel like we are on a bull trajectory, but it's basically consolidating in a very, very broad range. So that was my conclusion. Now, there appears to be a divergence that was present as the market moved down before. If you realize, if you recollect, when we were looking at our daily updates, when we had the daily update feature or morning show, as I used to call it, we would regularly check the index movers and then the various indices along with the genomic stocks. At that time, we felt that the tech companies were holding better than the wider markets, and the leading index mover were the last to fall. Because the QQ remained high, but we always heard that the market was going down and everything was going down. But our big tech 4 or 5 companies, they still remained at the very top. Now, in this context, look at this new headline, which I'm going to show you. This headline was in Yahoo Finance. It says a tech slump camouflages a rally sweeping across most of S&P 500. And it says the S&P 500 is technically still mired in a bear market, but a closer look below the surface shows that most of its stocks are in the midst of a big rally. While the benchmark is down 17% from its record high set in January 3, 2022, about 3/4 of the stocks in the index are up 20% or more from their 52-week lows, according to data compiled by Bloomberg. Among the standouts are Wynn Resorts and Boeing Company, which have both surged more than 60% in the past 3 months alone. So why is the S&P 500 ripping higher? Blame it on the ugly performance of a handful of technology-related stocks whose massive market values give them greater influence over the index that is weighed by market capitalization. Just 5 stocks: Apple, Amazon, Tesla, Microsoft, and Meta. Can we assume that because tech came down last, it should probably be the last one to move up? Could that be possible? And out here in Toronto, for example, the commercial office space vacancy is at an all-time high, close to around 17%. And part of the reason why it is so is because Shopify and other tech companies have curtailed growth and also have reduced headcount. This is over and above the work from home continuing for quite a lot of people. I have read elsewhere that the San Francisco office market vacancy rates are closer to 26%. So that's a very high number. And that should also give us an idea of how much of pressure there is on the tech companies. So probably we are going to see that reflected in the market. And if that is the case, does that mean that the tech has taken necessary damages and has touched the bottom? And the only way now is up rather than going further down? Does this turn out to be a signal that we have already come to the bottom and a turnaround is imminent or is in sight? How reliable is this signal? So that's the question. Does the market think that the debt ceiling is a nothing burger? What about the Russia-Ukraine conflict and the impending interest rate hikes? So those things are all still there, but then there is this news item about bond investors that I'm going to show you, about them being in a bind as they think, as the at the most, there may be 2 more small interest rate hikes, and some expect the Fed to indicate in March that rate hikes will be over. This does not mean rate cuts, but if the inflation continues to move down towards 3%, we can see rate being stable, and the moment it comes to closer to 3%, we'll start seeing cuts. So maybe the interest rate hike may stop in Feb, but I don't see any cuts until the inflation rate comes down closer towards 3%. That's when the cuts would come in. So that's what I think. Let's quickly have a look at the news article. Well, here we are in the news article, and it says bond investors are at a crossroad with Fed pause in sight. And we have a graphic out here. I don't want to get into the graphics, but there are some statements out here that I want to read out. Here it says, the market has discounted all the Fed's language about pushing the terminal rate higher than 5%, said Ed Al-Husseini, rate strategist at Columbia Threadneedle Investments. Having favored long-dated bonds in recent months, he anticipates intermediate sectors will fare best on the approach to the end of the hiking cycle. Eventually, once the Fed tells us that this is the last hike and March is a decent bet around that, then the front end is there for the taking. And it goes on to say, in swap contracts referencing Fed meeting dates, the expected peak of the overnight rate declined towards 4.9%. Just 29 basis points of increase are priced in for Feb 1 decision, indicating a quarter point is favored over a half point, and fewer than 50 basis points are priced in March. And then we have another one out here, which says the path of short-term rates is tied to inflation with a swing factor around that due to how strong or weak the economy is looking, said Jason Pride, Chief Investment Officer of Private Wealth at Glenmead. A 5% interest rate is necessary if inflation is running at 6% and 7%. Not so when the inflation is back down to 3%. And you could see year-over-year inflation headline inflation around 3% by the middle of the year. So again, he's looking at middle of the year. Some people are looking at somewhere around March. So overall, if you look at all these things, let's look at this sentence here. The 10-year Treasury yield, which peaked last year at near 4.34%, has scope to retreat to around 2.5% within 6 months if inflation trend is sustained. So overall, they are all thinking that things are going to get well very soon, somewhere between March and between June. So that's the thought process there. So to summarize, I think one of the scenarios is that in March, we will probably see a 25 basis point hike and the Fed saying that the hikes are over. I expect that if that is the case, then we are going to remain flat at that interest rate until we start inflation going closer to 3%. And that's when the rate cuts will start, not before that. So we'll get more data points which can help the market commentators as well as us to firm this up. On January 18th, we have got the retail sales data coming out. We are looking at having weak retail sales so that we can see that the inflation is coming down. Producer price index, that's another thing that's going to show the direction of the inflation. Industrial production, NAHB housing market index, and I think we have mortgage applications also coming up that will show the rate of mortgage application, whether it's increased over the last month or not, and how many qualified, those kind of information. And on January 19th, we have housing starts, jobless claims, both the data coming up. And on 20th of January, we have existing home sales. So when we take existing home sales along with housing starts and look at the mortgage applications, that will give us an idea about the health of the housing market, which is an important part of the economy. So a lot more data to come. So friends, after looking at all this, I still think that the debt ceiling issue is still the important one and can be a catalyst for recession. At times like this, it becomes so difficult to decide what the next step should be. Hindsight is 20/20, but how to make sense of these data points? Should we start investing now, assuming that we are at the bottom, or should we hold back until the debt ceiling issue is resolved? Because if you look at the sequence of things, the thought process expressed in these articles is that somewhere between March and June, everything is going to start looking good. But the debt ceiling drama is actually going to start around June, and it may stay unresolved until August or September. So a lot of volatility is out there. So even if we have any recovery out here, it's still going to be hit out there. So I don't know what to do with this. Again, I have another point of view for you guys to consider. After becoming a content creator, I've been acutely aware that coming up with meaningful, good content on a daily basis needs a lot of work. And it's very difficult. And I am doing only one video a day for 20 or 25 minutes at the most. So I can't help but think that the news media, which has to run 24/7 news cycles, how it gets all these different news items, how can it churn up so much of news items and give them a place of prominence? The editorial decision is going to be very, very difficult. And if you give more importance to something that is not important, then it's a head fake, because people start looking at it and thinking, oh, this could be something very important. I can't think of anything else but that media is looking at low-hanging fruit or some fancy situation and goes all in on it to fill up the media time until something else bright comes along. In my books, the most bright and shiny object right now is the debt ceiling. But as far as the media is concerned, they can't run with debt ceiling from now until August or September. So they are looking at various other things. So I would sum this all up to noise. Maybe the rest of S&P 500 moving up while tech lags behind does not mean anything in the overall context for us genomic investors. As far as QQQ is concerned, it will still be range bound as I predicted. I'm going to go with my original thesis. I still feel that with a stressed cash runway and with the interest rate being high, genomic companies are going to fare very, very badly until things get cleared up, and we'll get plenty of opportunities to buy good genomic companies at a low price. That's what I'm going with. Let us see what happens. Please let me know your comments below so that I can get your point of view. It's very lonely out here as a content creator talking to myself. So please engage with me. Put your comments below. Let's have a discussion. Thanks, guys, and have a great day and a great weekend. I'll catch up with you on Monday. Bye for now.